That perfect offer your sellers just received? Not so fast. It might be a financing disaster waiting to happen. Hey, I am Gurfinkel, and after reviewing thousands of pre-approvals, I'm sharing the exact red flags that signal a buyer's financing may fall apart and what questions to ask before your sellers accept any offer. Here is the 5-point pre-approval checklist every listing agent needs, because not all pre-approvals are created equal. In fact, many aren't even worth the paper they're printed on. Let's face it, we've all been there, we've all seen them. So here is your 5-point checklist to separate solid pre-approvals from risky ones. Point number 1, verification level. Look for language indicating the lender has verified income, assets, and credit, not just ran a credit check. The strongest pre-approval will say income and assets verified, or better yet, underwriter reviewed. Point number 2, specific loan program. The pre-approval should exactly specify which loan program the buyer is approved for, conventional, FHA, VA, etc. If it's vague or says multiple programs available, that, my friends, should be a huge red flag. I don't need to tell you that there is a huge difference between a conventional or an FHA pre-approval, right? So there you have it. Point number 3, down payment amount. Strong pre-approvals state the exact down payment amount the buyer is approved for. Or in case of the pre-approvals my team issues, we show you the purchase price and the loan amount. Clearly, the difference is the down payment. So be wary of pre-approvals that do not mention down payment or say up to X% without specifying the amount. Point number 4, expiration date. Valid pre-approvals have an expiration date, typically 60 to 90 days from issuance. You know why? Because the credit reports expire in 120 days. If there is no expiration date, that by itself, to me, is a huge red flag, because either they haven't done the thorough review or the credit report has not been ran. So what's the pre-approval based on? Point number 5, contingencies or conditions. Look for any listed conditions the buyer must still satisfy. The fewer conditions, the stronger the approval. If it says subject to verification of income and assets, that is not a true pre-approval. That means they haven't even looked at their income or at their assets. For example, last month I reviewed a pre-approval letter for a listing agent that looked impressive at first glance, but it was missing specific loan program. It had an unusually long list of conditions. We called the lender and discovered that the buyer hadn't even provided bank statements yet. The agent advised their seller to accept a different offer, avoiding a likely financing failure. So here are some questions that you want to ask your buyer's lender that reveal hidden problems. When you receive an offer, a quick call to the buyer's lender can reveal potential issues before they become deal killers. Here are the exact questions to ask. Question number 1, has this file been through automated underwriting? If the answer is no, the pre-approval is essentially meaningless. However, I will give you a couple of exceptions to that rule. USDA is one of those programs where I'd say about 80% of the time, the file may be ran through automated underwriting, but at the end of the day, it's a manual underwrite. Here is another example. Pretty much majority of VA loans can be a manual underwrite. So there are exceptions to the rules, but if you're looking at a conventional, at an FHA, or potentially a jumbo file, then those questions become of utmost importance. Question number 2, have you verified the buyer's income and assets or just reviewed stated information? Verified information, of course, is much stronger than stated because, again, let's face it, the buyer can state anything. But when it comes to verification, it may turn into a whole other ball game and is a huge red flag. Question number 3, are there any red flags in the file I should know about? A good lender will be honest about potential challenges. I'll give you an example. This one actually was more on the cute side, where a listing agent was actually grilling me and asking me these questions exactly about a buyer that I issued a pre-approval letter for on their listing. And she literally did ask me, what is your biggest regret or what is your biggest issue with this pre-approval? And in that case, it was such a squeaky clean transaction, huge down payment, amazing credit scores, etc., that I literally had to tell her that my only downside to this file, to me, is that my loan amount is a fraction of the purchase price. So yes, an honest lender should be able to answer any question that you ask them. Question number 4. What is your average closing timeline for this loan type? And what could cause delays? Now, this reveals both their experience with the loan program and any and all potential issues. Given an example, if it's a rural property, the biggest issue in my experience with rural properties has been how long an appraisal may take, because the availability of appraisers in a lot of the rural areas, regardless of the state, is sometimes, many times, very limited. So yes, getting an appraiser out to Timbuktu may potentially be a delay. So we talk about it absolutely upfront. Or again, coming back to USDA, any file, any USDA transaction, no matter how fast we run through it as a lender, still has to go back to the USDA for the final sign-off and guarantee issue. And USDA turn times change daily. It may be 3 days in a review today, or it may be 10 days in a review next week, depending on the volume of files they have incoming. Something that none of us absolutely can control, right? So knowing those things going in and setting the clear expectations and hearing that from the lender, to me, is more than important. Don't you agree? Question number 5. What's your company's closing ratio? What percentage of your pre-approvals actually close? This, by the way, is an amazingly great question. Anything less than 90% should be concerning. Guess what I'm hinting at? Online lenders. Because the majority of reputable independent mortgage banks, the majority of brokers, worth their salt, should have a closing ratio of upwards of 90%. And I actually tell my buyers the same thing when they're looking for an agent to represent them. Listen to the way the lender answers these questions. It will tell you as much as the actual answers. Hesitation, vagueness, or defensiveness are all red flags. A confident, specific response indicates a solid pre-approval. The one thing that I do differently is I actually proactively call the listing agents on the offers my clients make. And I offer to have a conversation about the buyer's pre-approval, the conversation about the buyer's strength, and how fast we can close. And if you as an agent are not familiar with the program that we have pre-approved the buyer under, I'm more than willing and able to explain the details of that program and why we chose that program for that particular buyer. Case in point, I just closed a transaction for a buyer. We closed it in less than 15 days, and it was a DSCR purchase for a rental property. And the listing team was not familiar with the DSCR program, and it happens. No judgment here, right? But I explained to them, and that's what I put on the pre-approval letter. It's a DSCR non-QM loan. I explained to the listing agent what the DSCR program was, that the funds were coming from the 1031 exchange that's already been verified. The sale of the relinquished property has already closed. The money is already sitting at the 1031 exchange company. So all we need is an identified property, an appraisal, and basically we're golden. And that's what you really should be looking to in a lender representing your buyer, is open, honest, and complete communication and confidence behind the pre-approval. Now, how to compare conventional FHA and VA offers fairly against each other. Different loan types have different risks and benefits for the sellers. So here's how to evaluate them. Conventional loans. Generally, the cleanest and the fastest to close. Again, generally, there's always exceptions to the rule. Minimum 3% down, but the perception is that the stronger offers typically have 5 to 20% down. Appraisals are typically less stringent than government loans, but the reality is it's up to the individual appraiser, because if they choose to pick the property condition apart, they're going to do that no matter what the loan type. FHA loans. Perceptionally, more stringent property requirements that could lead to required repairs. Again, perceptionally. Minimum 3.5% down. Appraisers may call out issues that conventional appraisers would overlook. Again, maybe, maybe not, depends on the appraiser. We don't control the appraisers. VA loans, zero down payment, but contrary to popular belief, VA loans actually have the highest closing success rate of all loan types, about 95%. That's pretty damn high. And funny enough, being a zero down loan with no skin in the game, VA loans actually have the lowest default rate during the downturn. Zero down, no skin in the game, perceived as higher risk by a lot of sellers and real estate agents is a complete myth. Appraisals on the VA loans, yes, they can be quote unquote strict, but the recent VA updates have streamlined the process significantly and compressed the times for delivery of the appraisal back to us, the lender. They used to take longer. Now, one more thing when you're looking at a VA offer, and this is more from the heart than anything else. The reason somebody has VA eligibility is because they've served our country. It's an earned right. It is not available to everybody out there. So VA zero down is something that they've paid for with their years of service, and a lot of times with their health. I always give preference to my VA buyers, and I always give preference and I always thank them for their service. And I hope you do too. When comparing offers with different loan types, consider the down payment amount. Yes, a lot of people feel that higher is generally safer, although I can prove to you that it ain't always the case. Earnest money, more skin in the game, that one I do agree with. Lender's reputation experience with that loan type. Again, if you're dealing with an online lender with a low closing ratio, just Google the lender for God's sakes. The pre-approval strength based on the 5-point checklist that I've spoken about earlier, the property condition relative to loan type, and the requirements. If you know the property is basically a fixer, any Govy loan type, meaning FHA, VA, and USDA, is going to be a no-go. Again, as a general rule. Even conventional may be a stretch. If the property condition is so-so, we can roll the dice and see what happens. But again, a good lender should be asking you about the property condition and should be asking you about anything they need to know about the property before ordering the appraisal so that we're prepared to address it as the appraisal rolls in and out of the system. So for example, if your listing needs some work, a conventional offer may be better and safer than FHA, even if the FHA offer is slightly higher. Conversely, a solid VA offer from a veteran with excellent credit shouldn't be dismissed simply because it's a government loan. So the truth about the pre-approval letters versus pre-qualification letters has been an ongoing raging debate, not for many years. These terms are often used interchangeably, but they represent very different levels of buyer vetting. Pre-qualification, based solely on information the buyer provides without verification, often automated and completed online in minutes. Essentially, worthless as a predictor of closing success. Sorry guys, don't hate me. Pre-approval should include credit check, income and asset verification, and automated underwriting system approval. Much stronger indicator of ability to close. Really, seriously. We've done our vetting. Pre-underwriting should be the gold standard. Unfortunately, it's not. The file has been reviewed by an actual underwriter and approved subject only to property-specific items like appraisal and title, maybe some minor buyer conditions. These buyers are as close to cash as you can get with financing. And by the way, my team takes it a step further. We actually have a cash guarantee option with a pre-underwrite, which does make it as good as gold and as close to cash, or actually sometimes even better than cash, because cash buyers can knock the price down after inspections. The pre-approved buyer with a cash guarantee usually does not play those games. Now, how do you tell the difference? Look for specific language like, this file has been through automated underwriting, or this file has been reviewed by an underwriter. If it says pre-qualified or doesn't specify, assume it's just a pre-qualification. I recommend asking buyers to provide a pre-approval certificate rather than just a letter, because these certificates typically provide more detail about the verification levels and conditions. Down payment sources can be a red flag. Where the buyer's down payment comes from can be a major indicator of closing risks. So here are some specific red flags to watch for when it comes to down payment. Are you listing a home or reviewing offers right now? Send me the pre-approval letter from your buyer's lender, and I'll give you a free risk assessment within 24 hours, sometimes within even a couple hours. I'll tell you exactly how solid their financing appears and what questions you should ask before accepting. Or better yet, recommend that your buyers get pre-approved with a lender who provides the detailed verification that gives sellers the confidence. The link to my pre-approval review is in the description. Let's make sure your sellers don't accept an offer that's likely to fall apart.